Sorry, Martin. What we might do is just kick off from the top with just a quick run through of your core market model, if you.
Oh, okay. All right then. So we'll start with the core market model, and just to be clear, we started looking at it from a household perspective, right? So there are people looking at loans, there are people looking at banks. We look at households. We run the surveys every week. We have 52,000 households in the survey at any one time. 1,000 new come into the survey each Tuesday, and that information then goes directly into our core market model, which feeds all of the analysis that we do. It goes to the blog, it goes to the industry reports we produce, and it goes to our clients. But very importantly, it's real time relative to pretty much all the other surveys that are out there. And, you know, the interesting challenge is when the data is shifting around so much as it is, the question is, how do you deal with that? Because essentially, if you look back over 52 weeks, then, you know, 48 weeks or so perhaps will be less relevant than the last one. So what we've done is to make some modifications to the way our model works to give much greater weighting to the most recent data over the last 4 to 5 to 6 weeks, because households, frankly, are in pretty much a lot of stress at the moment. And if you go to the next slide, you can also see that we can slice and dice the data, whether we look at segments from young to old, from affluent to less affluent, whether we look at property status from those who own property or those who are inactive, whether you look at those trying to get into the market or trading up or trading down, or even locationally. And that's important to understand, because generic averages, whether it be home price movements or whether it be incomes, tells you absolutely nothing at all about what's really going on. You need to get granular. And so the granularity in our core market model is essentially what we're going to discuss now as we go forward.
Okay, so Martin, actually, just while you're on that one, so you've got these categories, sort of want to buy, first timers, holders, and refinance, as we sort of run down. In terms of changing, like how do you change people between those categories, and what are you seeing at the moment in terms of people shifting between those categories?
Yeah, good question. So they are relatively stable, but obviously, you know, you're a first-time buyer, and then you become somebody who might refinance or trade up or trade down. So essentially, those households are identified at the point when we survey them. Now, we don't have a panel. We have effectively a statistically accurate sample of 1,000 each week based off the ABS. And that means that we can, at the point in time, simply identify them as to where they fit at any one point in time. So we don't track individual households over time, but we do know that over time, people do go through this life cycle. They want to buy, then they decide to buy and become a first-time buyer, and then they hold a property, they might refinance, they might consider trading up or trading down, and they also might go into investor land as well. So that's the way we do it. And what's interesting, of course, is that over time, individuals then effectively can move from segment to segment, but statistically speaking, other people are moving in other segments. So overall, the picture may be different at a macro level relative to individuals.
But I guess I'm assuming that there's the people wanting to trade up is sort of is probably not that great at the moment, or people wanting to, I don't know. I guess that's probably the key one, isn't it? That sort of fits into this in terms of where people sit.
The interesting thing, trading down was very, very active. So there were a lot of people up until quite recently who were sitting on quite large amounts of equity, particularly older households, and they were looking to sell. And what's interesting is that even now, I think the listings, the number of properties for sale are actually not falling that much at the moment. They're actually quite high. And that's because there is still quite urge from those to get out while they can and try and save some of the equity that they've got. The trading up group were beginning to get more interested in buying back into the market because of the price falls, although in fact the price falls were not uniformly spread across the country or indeed across particular property types, but they've pretty much gone off the boil. The ones that were active were first-time buyers, so people who were trying to get into the market, attracted by the government incentive scheme, or bribe as I call it. They've tended to sort of step on the sidelines now because of what's happened. So yeah, a lot of the action is in the trading down, and then property investors. So there are a lot of property investors who actually have been trying to get out because the property investor calculus doesn't work anymore. Rentals are falling, property values are not growing, and the issue of how you actually make an investment property work in this environment is probably beyond many. By the way, many property investors were relying on Airbnb. And of course, the Airbnb sector is now completely stopped. So that's another reason why many investors are struggling.
Yeah, it's an interesting thing, isn't it? We have an office in a WeWork building, and it's the same issue there. It's things look great, and you get to make lots of extra money most of the time because you've got all these short-term people who you can charge much higher rents to. But I think they're very much feeling it right now as the Airbnb people is basically saying you're getting paid a premium to rent out on a short-term basis, because when you get downturns or things go wrong, all of a sudden your clientele evaporates and you've got no recourse to where the money's coming from. So yeah, I think we're certainly on that with you there, that there's a that game of the whole short asset liability mismatch is what really comes to the fore at the moment. Whether you be a bank, whether you be a WeWork, or whether you be an Airbnb holder, you really do notice it at this point.
Correct. And of course, APRA changed the calculus as well in terms of how much could be lent to allow 80% vacancy rather than 100% vacancy rate as a guide, right? Now, in my surveys, I'm now seeing vacancy rates are considerably lower than they were even 6 months ago for many investors. And that's true whether you look across Sydney or whether you look across some of the regional centres or in Melbourne. The property investment sector is really struggling at the moment.
Yes. But and having said that, I guess if you were given the speed of it as well, if you were someone sitting there thinking, hey, I really should get around to selling that property, and the crisis hit, and you went, hey, I really need to do it now, chances are your property is still only maybe just coming onto the market at the moment. Even if you jumped very early, it takes a couple of weeks to get everything set up and going.
Yeah, so some of my industry contacts are suggesting that there have been quite a lot of inquiries from people saying, can I still put my property on the market? Of course, they can only do private sales. And then, of course, there's a debate about if you put a private sale into the market, do you get a reasonable estimate of what the value of the property is? One of the issues about property prices generally is you need market discovery to be going on to know what property prices are doing. So if market sales drop dramatically, as I think they will, then it's going to be very hard to get a read on what real prices are. And maybe some of the indices that are out there aren't actually giving a really strong read on precisely what's happening. Therefore, people are not confident about what they might end up with if they do so.
The final auction clearance rate came out this morning for last weekend. It was the lowest I've ever seen at 37%. So yeah, not a lot of price discovery on offer there.
And if you look, a lot of those were actually in the prior 2 weeks rather than last Saturday.
Yeah.
Okay, so should we jump to the next one, the Household Financial Confidence Index?
Yeah, so one of the things we ask about is directly households, how they're feeling, right? And I've been tracking this since 2013, and it's never been as low, but it dropped another 20 points this last month. So we were already low, we're now ultra low. And what's interesting is that the confidence levels are decaying, whether you look at young people or old people, whether you look at property investors or owner-occupied, it is consistent across the board, and it's driven by escalation concerns about job security, income definitely under pressure, cost of living still rising, debt is now a major issue. More people are waking up to the fact that the debt they're holding is actually a real risk. And of course, net worth has dropped for many as well, particularly those with share markets. And if you go on to the next slide.
Actually, sorry, and just to confirm your financial confidence, you can go to the next slide, but just to confirm, can you just define your financial confidence index just for those?
So basically what we ask is, we ask households a series of questions. Compared with 12 months ago, are you more confident or less confident about your job, about the amount of debt you hold, about the savings that you hold, your income, your cost of living, net worth, those sorts of things. And we then calculate based on their responses, those who are stronger, those who are weaker, and the confidence is looking at their household financial confidence. So it's quite specific on those dimensions. And the next slide, if we go to that, we can slice and dice it. So we've actually got those who are mortgaged, those who are in rents, and those who are what I call free affluent. So those are people with property, but with no mortgages, often with shares as well. And it's interesting that in the last month, it's the free affluents who've seen their confidence levels drop the most. Everybody's dropped, but in fact, the free affluents are responding to very significant drops in the stock markets recently. So it gives you a real-time read as to how people are feeling. And of course, that then tells you about what they're likely to do, because we also ask some forward-looking questions in terms of, are you likely to transact? Are you likely to buy? Are you likely to sell? And I can tell you that the number of people who are thinking of transacting in the next 12 months has dropped dramatically, despite what I said about people piling in immediately. And the other factor there is that many people are also now worried about the amount of debt they've got and are thinking of trying to refinance to try and get some of the cheaper loans that are being offered by the bank. So that's one of the major to-do lists that many people have.
So one of the questions that sort of jumps straight away to that to me is, I mean, it's obviously very sudden and sharp, but as you'd expect, I guess the levels it's fallen is hard to tell how significant that is or that isn't for economies and everything like that. But so how far back does your data go for this one?
Goes back to 2013, so you can see that the trend data there is back to 2013.
And I'm assuming that this is sort of similar in a way to some of the consumer confidence type. I guess this is a much more granular look at how at some of at what you see in, say, some of the other consumer confidence surveys that are a lot broader, and you can't really disaggregate them as you can with your data. But in terms of those types of things, when they do have a sudden drop. Say it's the during the financial crisis, or I guess recessions. I guess you have to go fair way back to the prior recessions in '90s and things like that. The expectation usually is it takes a very long time for these to actually come back. Once they drop, it doesn't confidence doesn't drop suddenly and then bounce back suddenly when everything's clear. It seems to people seem to be a lot more circumspect, and it takes a length of time before you get that recovery. What's your sort of expectation about let's say it was an all clear, virus solved, vaccines, everything's all great. In a perfect world, how long would you expect that to take to get back to a more normal level?
Well, I think it's months rather than weeks. And I think it goes back to where unemployment's going to be. So I think jobs and unemployment is going to be the key to this, right? If in fact we get a resurgence in jobs and, all the small businesses that were going to fall over don't fall over and can still employ, we might see people then feeling a little bit more comfortable. Because in a way, for most people, getting money in, and by the way, this is all about cash flow, as we'll come on to in terms of mortgage stress, money in, money out, right? Is sufficient money coming in to be able to deal with my financial commitments and my mortgage repayments or not? That's the critical sort of question. If the answer to that's no, then there's very little that people can do other than hunker down and just spend less. And remember that half of the economy is household consumption, right? So if that continues to drag, that's going to have a significant knock-on effect on the broader economy. If in fact it bounces back because people are actually feeling more confident about their financial status, then everything else flows. So I think unemployment is really the leading indicator. Although it's a lagging indicator, it should be the leading indicator as well as to how quickly this is going to bounce back.
Yeah, absolutely. And I'm very much on with you there. And that was where I was leading with this question, is because to me the real thing, and I'd say, obviously your data doesn't capture any of this, but I'm going to be fascinated to see how it changes over time. Is this, so we've got this job seeker plan out there where basically, I think I've got this right, is you get fired, but then they say, well, no, your company's going to keep paying you, but we'll pay the company, and they'll keep paying you 80% of your salary up to a certain level. The real question is, will people get that and feel like they still have a job and they still feel confident, or will that be sort of relatively indistinguishable from being unemployed? Except, there's still it's almost as if you're living off your own savings for a little while, but you still suffer that same sort of, I guess the same confidence shock that you would have if you had been unemployed anyway.
Yeah, well, I mean, I've only got 1 week of data on because it was announced last week, but it's being regarded as a quasi-dole rather than as a replacement for existing income. And of course, the issue is that you might push people forward for a few months while this is there, but what happens after that? Yeah. What happens when the government's support disappears? Because this is temporary. This is not a permanent change to the way that incomes are being supported. It's not a UBI. I think we should have done a UBI personally rather than this. It's all being funneled through the commercial sector, and that then is the big question in terms of how this plays out.
Yeah. Well, and the other thing.
Sorry, before we shift again, Can I just ask a question in terms of sort of rebounds and V-shapes and drop-offs and what have you, Martin? When I look at your first chart there, what really strikes me before the cliff is just how dislocated confidence had become from the housing rebound. Like since 2016 when, obviously we had the sort of Royal Commission bust, but then, ScoMo gets elected and injects credit and we saw this price rebound. But it just, financial confidence in households, if anything, just steepened further down. And so it's like we're kind of having this shock within a structure of deeply depressed sentiment already. And I'm just wondering if you could give us a bit of granularity on why you think that confidence has been sliding so hard and whether it will play a role in any possible rebound.
Yeah, great question. The answer is it's all about income. Incomes have not grown in real terms since 2014, 2012 for many households. The cost of living are continuing to spiral higher. Up until recently, probably still doing it now. So many households, from a cash flow perspective, were actually feeling it. Plus, of course, the fact they had bigger mortgages, and whilst the mortgage interest rates were dropping, the actual amount they were paying was not dropping. And if you look at the amount that people are paying on average, it's roughly the same as it was 5, 6, 8 years ago. So that pincer movement of depressed income, also, by the way, lack of hours. So many people were underemployed and therefore they weren't getting any overtime. So that's another reason why incomes were compressed. I think that's the key. So we've actually had an economy that has not been firing well for the last 4 or 5 years. And in the last 6 to 12 months in particular, we've seen a significant drop in household expectations of future income and ability to service. So that's why the mortgage stress numbers are rising. We'll look at that in a second, and why some of the other factors are all playing in. So in a way, the property market was a bit of a, abnormality. And by the way, I think some of the indices were overstating the real movements if you look nationally, but that's another story, I guess.
Yeah, and sorry, before we move on to that one, I just want to jump in on that last one. The just talking about that whole UBI versus company payment. For me, the best thing you could have done was to have something that actually encourages companies to keep people employed. Whereas it seems to me, and I'm not completely on top of the whole process, but it seems to me that the process almost seems to encourage companies now to go, look, I can't really afford to keep this person on, but if I fire them, I can keep paying them. It's not like they'll keep getting their $750 a fortnight or a week or whatever to keep going. So I don't have to feel as bad about firing them. And I almost wonder if that's actually going to encourage people to fire, whereas if it had been something that's sort of based around saying, yes, the payment mechanism might have been exactly the same, but it was based around companies having some sort of obligation to keep people employed and to keep them on the books, so that when you do get out of this, those people are straight back into work. It's sort of like saying, yes, you do have to sit at home, and the payment's coming via the government, but as soon as everything's right, then you're back and working. Whereas at the moment it seems the other way around, that it's almost like no, I have to fire this person first, and then they can get their payments, and then
rehire them again.
Then rehire them, or have to go through a whole hiring process afterwards. Yeah. And for most companies, especially the big ones, there will have to be a hiring process afterwards. You're
in effect suspending demand rather than pausing it and firing it up. Yeah.
Well, what I think you're doing is massaging down the unemployment number. That's one of the reasons why they're doing it first. Secondly, because it would have been, Westpac said 17, they've now taken it back to 9, right? Secondly, the fact is that because of the way it's structured, you actually might want to keep on some of your people for the higher incomes rather than lower incomes, because there might be some tax advantage to doing it. It's a really weird formulation, in my view, that's going to have some significant unintended consequences. And remember, of course, it doesn't cover casuals. It doesn't cover people who've been employed for less than a year. And I think accountants will be kept very busy also proving certain things about, how much income or not a business has got compared with last year and all those things. There's a bunch of issues that flow off the back of this.
Yeah, well, and that's that whole part, isn't it? So we've really only had 4 weeks of really sort of stricter shutdowns, and a lot of companies, and especially the small businesses I know, run on the basis of a shoebox and I'll try and sort everything out once a year when I have to pay my taxes. So to then ask them to, can you just provide me with up to the minute effectively, as at the end of February, things weren't too bad. So, even it's not even your quarter end numbers. It's just you're sort of saying, well, even if you look at your quarterly numbers, you've got 2/3 of a decent and one third poor. So yes. Anyway, let's jump on to mortgage.
Yeah, well, Martin. Just before we jump across to the mortgage stress theme, although this is quite a nice segue. So obviously you've got this rapid deterioration in household confidence in this index we've got on the page here. Just your thoughts, I guess, from a corporate confidence point of view, and I draw as an example QBE pulling new mortgage insurance on people in COVID affected industries. Do you feel that it's basically tipping fuel on the fire, and perhaps then we can segue into our next slide?
Yeah, well, certainly my SME surveys, which I haven't covered in this presentation, about half of SMEs have cash flow issues now. So, they're not going to get any relief for some time, and they have major issues. So many will be struggling. With regards to the interaction between mortgage payments, mortgage stress, that's the really interesting question, because of course essentially banks are now beginning to offer mortgage payment holidays. In other words, capitalize the mortgages for a few months. That creates some space for those people who may still be employed, but if you aren't employed, it doesn't make any difference, because you won't be having enough in way of support to be able to necessarily make those mortgage, so they don't have to pay the mortgage, but they've got other things going on as well. So that's the point there. And one of the things I keep coming to is you've got to look at households' finances in the round. You can't just look at the mortgage payment in isolation, because of course households have many other commitments as well, things like school fees and childcare costs. I'm already seeing a lot of people pulling their kids out of childcare or not using childcare and trying to get refunds on those on school fees to try and deal with this cash flow crisis. This cash flow crisis is the real critical issue that I think people aren't talking about yet, but they should be.
Absolutely. And so if we roll through the page we've got up here was just that mortgage stress, examining the household cash flows. What do you think are the sort of the key components there? I guess working a little bit on that last line.
Yeah. So the real issue is, of course, that we look at cash flow rather than actually a 30% of income. That's the standard rule that everybody quotes, but doesn't really tell you very much. So I look at real cash flow. And essentially what we're looking at is if households are in stress, that means they've got less cash coming in than they're actually paying out. If they're deeply negative, let's say 10% gap, then they're in severe stress. And I think we need to make some comparisons here. WA is a really interesting case study because WA has been in strife for some years. Unemployment was a lot higher there, under the same credit conditions as the rest of the country, and we had higher levels of mortgage stress, higher levels of price falls. And so the correlation between mortgage stress as an early predictor of what happens to home prices is actually, I think, quite interesting. It doesn't happen immediately because mortgage stress is something you can manage by hunkering down, drawing down on deposits if you've got those in deposit accounts, or putting them on credit cards, but it gets you in the end. And that, I think, is, by the way, also we look at rental stress separately too, and we're seeing some quite interesting correlations there. So that's the way we do it, and that's what we come to. And perhaps if we look at the next one, which is the stress trends to March. Now, the yellow line is...
And actually, before you jump into that, Martin, it's worth just noting as well. So let me get this right. The WA jump in unemployment was probably only about 1.5%, 2%, I think. It went from very low to a little bit above average in terms of versus the rest of the country. So we're obviously mortgage stress on that under those great financial conditions, and so there's obviously
remember interest rates were being cut.
Yes,
at the same time, right? So effectively, it should have been better than it was, but prices in WA are down 21% on average. In some postcodes, like some of them down the west coast are down 30%. If you think at places like Mandurah, that's, if you like, my example of a case study of the worst of the worst. There you've got 30% drop in home prices. You've got social issues. You've got druggies. You've got people trying to sell and not being able to sell because they've got negative equity. I worry that what we see in the east will be what we saw in the west, because essentially we've got some of the same issues now beginning to flow over. Yeah, absolutely. And a bigger jump in unemployment. Yeah, bigger and probably more significant in terms of the shock. Go on.
I was going to say, we'll jump across to the young family and the urban fringe you feel are the most exposed to this?
Yeah, just go back one slide. You've probably jumped ahead. Let me just go on the mortgage stress trend slide first.
Sure.
So this is the killer slide, frankly. So the yellow line is the one. This is my mortgage stress trend from 2000. So it's right the way through the last global financial crisis. And you can see there that last time in 2008, we were tracking up and then we actually eased back. The reason we eased back was because rates were cut and we didn't have a significant issue really with households in stress. But then it started to build, and it started to build over the last 2 or 3 years, for the reasons I explained in terms of incomes, the fact that if mortgages were bigger. And then we've started to see an acceleration. Back in February, it was 32.9% of households, more than 1 million. This month, it's jumped to 37.2% of households. So literally another 200,000 households are now registered as stress from a mortgage perspective. And you run that forward based on what I'm thinking is going to be playing out, we're going up to 41.7%, right? Now, that is a huge deal because it means that we go from 1.08 million households in February to 1.36 million in March, directly related to job cuts, directly related to financial pressures. Now, obviously, some of those will be alleviated in the short term by the fact that they will have mortgage repayment holidays. But by the way, my surveys say that about half of people who've been applying for holidays are not getting them. So it's not universally accessible and available so far. I'm not sure why that is, whether it's a process issue or whether it's that the banks are actually still applying some responsible lending criteria to the situation. And I remember that Shane Elliott said, look, we can help for a period of time, but eventually, not everyone's going to be able to survive, and I'm thinking that's probably what we're seeing.
Actually, the interesting thought around that while you're on the point though is, so I wonder how keen banks would be to actually. I'm assuming they're not going to be very keen to repossess and to be trying to sell properties into over Skype to people.
Well, you're absolutely right. And if you look at the US, there was a massive situation where lots of people started to default and the banks didn't do anything. They didn't try and sell because they knew that if they tried to put more property into the marketplace, that would actually just depress properties even more. And so many people in the US are still, years later, still living in properties that they no longer are paying mortgages on, but they're still in the properties. So there is an overhang. And of course, the other thing is, do you crystallize the loss? Do you want to crystallize the loss? And I think it's very interesting that in the UK, the banks there have actually basically got the government to stop all house transfers and sales because they don't want to get a read on property prices. So effectively, if you freeze the market, you can freeze your book.
Yeah, sounds a bit like we've been complaining about all the industry funds this week, sort of on their unlisted assets, doing similar things where they're just saying, if we just write them in at last month's prices or the month before's prices, then everything looks much better.
Pick a value, any value.
Yeah.
And it's a very interesting question. What's the obligation on banks to reflect changes to property values in their portfolios? The answer is it's very vague, right?
Can I ask you, Martin, do you want to take a punt on how much distressed property this chart would represent?
Yeah, so defaults are different from mortgage stress, right? So defaults are still quite low. They're about 3 times higher in Western Australia relative to the East Coast. So we don't have a vast number at the moment. About 80 to 90,000 properties would currently be on the distressed pile. That would double, I think, under my modelling, based on what I'm seeing now over the next 3 to 4 months. Could go higher. So it's not a vast number, but it's enough to be slightly concerning. The worry, though, is, of course, that many of those will be LMI'd. And I think that the LMI sector is probably going to feel the pinch first. Wouldn't be surprised to see if...
Just for people out there, that's lending mortgage insurance.
Lenders mortgage insurance, so 80% above. Now, we already heard QBE stopped, basically, providing new finance for some types of borrowers. Now, also begs the question, do you remember that 95% guarantee the government offered for first-time buyers? That's looking quite interesting now, isn't it?
ScoMo Prime, man.
Yeah. Well, and we've just added 200 billion, have we? 150 billion, 200 billion to the national debt. So what's another 50 billion?
Yeah, it's in the roundings. Who cares?
Yeah, that's right. Throw it on the pile. Yeah.
Now, if I go to the next slide, I can then just decompose this because this is really interesting. So if you look at it from a segmentation perspective, right, young growing families, around 72% of young growing families, which include those first-time buyers, are most exposed from a mortgage stress perspective. And then we've got other segments like the battling urban disadvantaged fringe. Now, they're people who are often in those new estates on the outskirts of towns, a long way from anywhere. Now, the issue of defaults, I think they'll stay low because of the mortgage holidays. And if the unemployment rate, let's say goes to 10%, which is what I think the job keepers will keep it to, that will have a bit of a lid in the short term. I am most interested about some of these affluent households because they're very exposed due to market leverage. And they've already got margin calls, and they've got multiple investment properties. I wouldn't be surprised to see some of those more affluent, although they are relatively lowly represented in terms of the segmentation, actually being some of the first to fall over.
And obviously we saw that in the financial crisis. There's a lot of the financial markets are quite big particularly in Sydney, in terms of big employers of people with big mortgages. And so when the bonuses stop, then a lot of them have bought property on the basis of bonuses.
A lot of people have structured their situation around debt and more debt, and it being just part of what they service through their incomes. But if the incomes get shot, then the debt becomes unserviceable very quickly because of the leverage. And just as property values, when they go up, helps, when property values go down, it hinders dramatically.
Yes, and and you're not getting any rent rises, and you're probably seeing much greater vacancies. So yes.
Yeah, well, I had somebody say to me they've negotiated their rental down 20%. That's someone in Sydney. They went and said, look, I can continue to pay, but I can't pay as much. They agreed a 20% drop in their rent.
Wow.
Temporarily or?
Permanent. Yep. Property investors desperate. Now, if I go to the next slide, you can look at it by states. So this is looking at Tasmania. Tasmania has the highest proportion of households in stress. That's a combination of the recent run-up in prices and also the fact that incomes are very low relative to other states. Victoria, though, in absolute count, has the highest number of households in stress. Interesting, I've been watching the Victorian property sector. A lot of, I think, extravagant lending is now coming home to roost. New South Wales, of course, is there too. And then you've got the WA one as well. But the largest movements actually were in Victoria and New South Wales in the last month. WA, of course, continues to be declining because of what's happened over there over many, many months and years.
Fascinating. And what component do you think of this may have an impact with the basically vaporization of population increase through immigration? Do you think that's sort of coming through the numbers yet, or is that something that's on the horizon?
It's part of it. I mean, the demand for property is interesting, right? So demand has come off the boil, and migration is definitely down. It's probably out now.
Zero.
Given the travel bans. Overseas investments. There's a lot of information that suggests that some of those overseas investors are now trying to sell their properties, even now, particularly from China. We know that the migration from Western Australia to the east was quite strong, so we saw lots of vacancies, lots of properties that had no interest at all, even when they discounted by 20 or 30%. So that definitely is part of the picture. We also know that there's still been quite recent appetite down the east coast, stoked, of course, by recent property price increases and all the spruikers. Domain was saying the other day, hey, great time to buy an apartment because prices are low. Would you buy now? Well, I certainly wouldn't. So demand, I think, is probably going to be there, but as people get more hit by this income shock and the economic shock, I think demand is going to dissipate. And if you think about supply, demand and disequilibrium, how that translates to property price falls, you can start to see why it is that maybe property prices will begin to start falling.
Sure thing. Okay, yeah, very good. If we jump across to the major centres as well, just mindful of your time as well. We've got a few more slides to get through, Martin.
Yeah, okay. So just in terms of just by regions, it's worth showing that Melbourne and Sydney have the largest counts, as you'd expect, Queensland, but then some of the regional areas too. So the point to make is mortgage stress is not just something that lives in the major centres. It's actually quite widely spread. If I look across Queensland, for example, up in the Darling Downs and around there, or Mackay, I can see it in South Australia, or I can see it pretty much everywhere I look. Now that's worth just bearing in mind, because of course everybody focuses on just the two major markets, and we need to look beyond that. And if I go to the next slide, you can just see how the postcodes play out. So Fountains Gate, Narrow Warren has the largest number of households, and the Ballarat one at 3350 is also quite high as well. And so you can see that Victoria is right up there.
Absolutely. Sorry, something to add, David?
Well, that definitely looks like an immigration story, wouldn't you say, Martin? I mean, those are all of the fast-growing fresh migrant areas with the secondary markets and what have you.
I mean, not necessarily the lowest incomes. What's interesting there, the average incomes in some of those postcodes were not the lowest in the state.
Yeah, sure. I mean, you've only got to take a tour around the Melbourne Fringe to see, kind of endless paddocks of McMansions popping up all over the place.
And if you talk about that, look on the next slide. So this is actually geomapping. You can see where some of those hotspots are. So the darker colours are the hotspots. Beaconsfield around that area, that's where you find some of those McMansions and some of those high density areas as well. So often above average incomes and home prices, large estate corridors, often quite small plots, perhaps limited infrastructure. There's a pattern here.
Yeah. I actually think it's possible that over the next 12 months, at least, we might see immigration go into reverse. Because, I mean, it does have a very strong market component to it insofar as...
Where would you run to is the question.
Yeah, well, people might just go home, because they'll feel safer there, I guess, in at least for temporary migrants. And secondly, if there's no jobs, why do you stay in a foreign country? I think you go home to mum and dad, or, you retrench.
Yep.
So I do wonder about those fringe developments, how much pressure they're going to see.
Yeah, good point. Now, if I just go quickly to the scenarios, so we run scenarios off the back of our model as well. And so let's go to the scenario. So 24 to 36 months later, this is my estimate of what I think is going to go on. So you can see there that I've got some different scenarios based around what's happening with the health issues. We're, I think, in the global disruption or the longer term crunch scenarios. So I'm looking at home prices dropping 20 to 30% or 30 to 45%. And remember that if you build the average home price up from the bottom of land, construction costs and amenity costs, on average, prices in Australia are still 40% over where they should be based on any ratio you'd like to mention. So there's plenty of opportunity for prices to fall. And so that's where I'm putting my stake in the ground at the moment based on the data that I've currently got.
Okay, fantastic.
Sorry, can I just ask, are they real or nominal prices, Martin?
So this is basically taking the price today and overlaying inflation. So they're actually taking account of the inflation as well.
Okay, so they're real.
So
okay.
What's the difference going to be, David, over the next 3 years, do you think?
Inflation.
Right. Yeah. Well, sure. Yeah.
Pretty small.
Yeah.
Exactly. Yes.
But I do take account of inflation.
Might help to show it in real numbers.
Yeah. The household deflator might raise prices. Sure.
Very good. So look, before we roll into the investment outlook, stay on this one.
So let's have just a run through this some of these categories, because I think there's some interesting things within this. So your current mortgage stress levels were just jumped to 37. Was that right? Sorry.
Yep. Correct.
Okay. So as you said, unless the local difficulty is sort of off the table, and that's. And I'm just wondering, the bank losses, maybe those two have been flipped around. That might have been us accidentally flipping those around. So of 9 basis points, then 15 for the longer term crunch.
Yeah, I'm assuming that essentially the issue with regard to mortgage repayments and capitalisation will run longer.
Yep.
So that's why I've left that lower.
Right. Okay. Because I think the longer term crunch. So we're obviously almost there on the mortgage stress side, but the unemployment is potentially already almost there, or potentially already past that, isn't it? In terms of
could be.
It's and we won't sort of find that out for months until we really know. But that is a and the question on the RBA rates sort of going further down? What's your take and what's your assumption there?
Well, they keep saying we're not going to take rates lower. That was what they said in the release yesterday. And of course, they are theoretically actually at zero because of the range that they use. I still think that negative rates we shouldn't write that off immediately completely. The worry I have is that this gets out of hand with the amount of debt in the system. They're going to have to do other stuff too. Scary though it is, and therefore you start worrying about bailing in and bailing out and all of those horrible things that could be part of the story.
Yeah, absolutely. Well, we could do another whole episode. We probably will at some stage on the whole banking.
Just one more question before you wrap up. Martin, when and how much credit rationing do you see coming?
Lots. All the evidence is as rates go lower, and even with the stimulation and support from central banks tend to lend less. Look at what happens in Germany and in the Eurozone. In fact, one of the major reports came out and said the trouble is that banks lend less. They can't take deposit rates lower because basically deposits come out of the system if they do that. So they have to go into more speculative ventures, derivatives, those sorts of things. I think a credit crunch is part of the story here.
So therefore, we might expect APRA to loosen up as well.
Oh, just a bit more. Just why not? They've reduced the issues with regard to defining delinquencies. They've already, opened the taps.
Yes.
I wouldn't be surprised. They are desperate not to let property prices fall, but I think gravity wins, in my view.
Unemployment wins. Yeah. That's what we've been making that point, as you have, I'm sure as well, that most of the semi-good policy options you had to try and keep property prices high, we've already used that over the last few years, and so now you've really got to scrape the bottom of the barrel for the worst possible policy ideas you can find to try and prop things up for just that little bit longer.
Correct. And I think everyone's thinking short term, but we've got to think longer term, right? The amount of debt in the system is high. The amount of government debt's now very high. The economic outlook, to me, looks pretty shaky.
Thanks for all that there, Martin. We've obviously we might just quickly open up for questions as well before we round out with our investment outlook. And look, this has actually probably been one of the more popular chats. I don't know if it's questions or chats that are coming through, but I thank everybody that's tuning in and dropping in some questions or comments. I've got one here, and this is sort of in the theme of what we were just talking about then. But given the government's recent economic interventions, do you agree that any potential collapse in house prices is exposed to a major risk of political intervention, perhaps as opposed to a central bank intervention? Is that sort of something you see on the horizon?
Well, political intervention has been there right from the start. We don't have a free and fair market with regard to property. We haven't for years. They will do whatever they can to try and keep the bubble up.
Yeah, the critical question is are they out of ammo, not whether they'll use it.
Yeah. Yep. I figure they've got pretty good. They'll think of other things to do, and they'll get worse and worse. Each idea will be worse and worse for the long term, and probably have less and less of an effect on the market as we go in.
Couple more. I've got another one here from Hi Man. So based on the WA experience, with some factor built in for the COVID cash flow issues, bear with me. Just zoom through. There we go. What was the? Hang on. Roared through it all. Here we go. How long do you estimate before this translates into some form of house price decline in the other states? So how long are we talking before we start seeing some falls? And there's actually quite a few in relation to that. So you're actually scooping up quite a few questions in this one answer, as you could probably imagine.
Right. Well, I'll have a quick crack at that first. I really don't know. I think you're in the. I've called it the Wile E. Coyote moment, where we know he's off the cliff. We can see there's nothing underground. I don't know how much longer he's going to stay suspended where he is, but I think the government's going to try and do that for as long as they can and do what they can to try and keep it there. But at some stage, gravity's going to take over. Look, I couldn't see it lasting 6 months.
Gravity always wins.
Yeah, I couldn't see it lasting 6 months. So I guess I'm somewhere in the 0 to 6 range.
Probably need to have hold an auction in order to get a price discovery as well.
Yeah, I'll leave to you, Martin and David.
Yeah, well, I think it's already started. I mean, yeah, it might it might be that we see a lack of transactions that opens up a void of information for a while. But that's just a price gapping. And when they come back, you'll just find that you're 20% lower. But I mean, the daily indices that we follow at CoreLogic, which are obviously lagged, they're not yesterday, even though they're reported daily, started to weaken. And I think, realistically, the market would already be falling, probably nationally. What do you say, Martin?
I agree. The price is already falling.
Yeah.
The index is one lens. Other indices from other sources are actually already reporting deeper falls. So I think we're going to see falls.
Okay, very good. Right, well, there's plenty of comment in here. I'm struggling to actually find a lot of questions, though. So I think it speaks to a lot of fervour that there is in the topics that we're talking about. Everyone wants to put in, but outside of that, I think we've also possibly means we've covered off on it quite well as well. So I'll take that one. But
well, one of the questions actually popped in as sort of more of a comment about, won't the RBA just start buying houses? And I've joked about this in the past, that saying, in the Japanese central banks out there started by buying government bonds and then went into corporate bonds and then they went into buying equities, and to whether we'll be changing our mandates here to buy houses, but effectively that's what they're going to try and set up to do, isn't it? Is to try and set up and say, not directly, but basically saying, how can we pump money into people that will then go out and buy houses? And it's that part about, can you get the confidence in people? And my take would be that that's the type of bad idea that we're talking about, is saying it's going to, how much incentive can I shove down people's throats to try and actually convince them that a house, it's well worth them buying a house at this point in time. And I would be, I guess for any listeners, I'd be trying to resist any temptation you feel and any bribes that get thrown your way in terms of that. But I don't know if anyone else, if you've, David or Martin, you've got sort of ideas about where the next how the RBA is going to try and shove money into people's hands to get them to buy houses?
Well, they'll buy everything, and they will actually continue to go into all of those different avenues. But the point is, at the end of the day, unless households feel confident, they're not going to spend. And that's why I don't think this is going to be V-shaped. This is going to be a long, slow grind, I think.
I'm inclined to agree with that. The RBA is already buying just about everything it's going to buy. It'll be buying financial assets, not houses. But APRA is clearly the next cab off the rank. I mean, if banks start to tighten lending criteria, then APRA will loosen them.
And the question then comes back to the next question. One that's up there is saying UK banks have stopped paying dividends, and the New Zealand has said no more dividends from Australian banks that are in New Zealand. They can't send the dividends back to head office now. They've got to keep those in there. David, I think you were speaking this morning about having dividend reinvestment plans, but because there's this huge underswell of people investing in Australia who've invested in banks and want it for their franked dividends. I guess your thoughts around that, and Martin, then the same question to you about bank dividends and what you're seeing on that front.
Well, I think they're toast anyway, but I don't think there's enough courage in the regulators or independence from capture to do what they should be in terms of containing moral hazard, which is what New Zealand and Europe and the UK are doing. I mean, we put that suggestion this morning about dividend reinvestment as a kind of hopeful alternative, which maybe they'll go for, but I wouldn't be equally surprised to see the spectacle of the banks just, disgorging capital to shareholders right up to the point where they raise capital from new shareholders or from lenders.
Yeah, or government money, basically.
Or government money, yeah. I mean, I have zero faith in the regulars containing the Aussie banks to any kind of acceptable, measuring them on any sort of acceptable social norm or license to operate.
I put the government, the regulators and the banks on the same side of the ledger, rather than overseeing each other. They're all on the same page, and that's the problem.
I think that's right. If we had Labor, there's a bit of a maybe, but definitely not the coalition. They're all in bed together.
Yeah. So the question on that whole dividend front is, whether you just see effectively they're paying. I guess for listeners, if what David's talking about is if a bank pays out a dividend, they could then also do a dividend reinvestment plan, which basically then raises that much capital from other shareholders or from the people who decide not to take the cash and just take it, which effectively is just a way, really. So it's a zero-sum game in terms of there's no actual money going out, or whatever money goes out also comes back in. But it's really just a bit of a tax dodge in terms of it actually just gets rid of the franking credits from the banks out to people, which look, in the end, if that helps people feel a little bit better about their lives and get some spending, then it's probably it's a net wash. But it'll all come back to, for me, that whole part about, as you said, everyone's sitting on that same side of the ledger. Will we actually have some moral hazard, and will you get a blowback against that, against banks paying out dividends while other ones, and I'd say probably yes, but that might not be for another 6 or 12 months before that happens.
Well, you got to ask where the blowback's going to come from.
Well,
I mean, it'll come from the people on this podcast.
that's right.
Spot on.
It won't come from the mums and dads who want the divvies. It won't come from the government. It won't come from the press.
Yeah.
It wouldn't know if a bull was up them. So this is why I have no faith.
Well,
there's no accountability in the system.
Yeah. Well, and I guess it's a question about, isn't it? Who's going to be blamed for it because that's the key thing now is we just need to work at is all governments are trying to work on the blame shifting, and so
Well, that's easy. It's the virus.
Yeah. Well, and possibly China, it looks like is increasingly so.
The new scapegoat.
So the government was always looking for something that they could basically deny accountability for all the bad decisions they've taken over many years. And the health issue basically is a wonderful scapegoat to do things that they wouldn't otherwise be able to get away with.
Yeah, it disguises that 4 or 5 year chart of declining confidence, doesn't it, Martin? We've had 4 or 5 years of effectively driving the economy and the household sector in particular into the ground.
Yes.
And now the virus will be able to take the blame for all of that.
Correct. Yeah, exactly.
Well, and it's that whole thing as well. If you run your systems to the complete limit with absolutely no room for error, and then something happens and you say, oh well, there you go. It's
Well, some people have been saying for years, debt's a problem, household debt's a problem, and I say again, household debt is a problem.
Well, okay, let's give, in the interest of time, we might just jump to. I'll just jump to our investment outlook. Thanks for that, Martin. Did you want to? Actually, okay. Let me jump in. I'll quickly do the investment outlook, and then we'll let you do a quick wrap up to tell us where people can find more about you.
Perfect.
So just on our investment side, so we've just wanted to put this for investors in our funds. So the month end's just finished. For most of the funds we're running have significantly, or all of them have significantly outperformed over the month. Our income fund did the best, was up a little bit versus the ASX down sort of 20-something%. The growth fund, which is our highest risk one, was down a little bit under 1%. And then all our direct shareholdings. So the ones with direct international and our direct Australian funds both outperformed by about 6 or 7% over their respective indices. In terms of our investment outlook going forward, coming back, exactly what Martin was saying. Unemployment is our number one issue as well, and trying to work out. There's a shift from saying, okay, we're not going to call them unemployed. We're going to keep calling them employed, but they're going to be paid by the government, via companies, and so there's really not a lot of difference. And trying to work out what the effect is on people, because that's the one. Employment is usually a very lagging indicator, but it's also very slow to come back when you go through crises. And so if the more people that can stay employed, in our view, then the faster the recovery will be. But I suspect we've already missed our chance to keep that, and I think you will end up with significant numbers of unemployed, if not in official statistics, at least in the way people look at themselves and their own jobs, which is the big issue. So in terms of the three main asset classes we're looking at, equities. So look, the issue is at the moment is consensus earnings are completely useless. You haven't seen the downgrades, and it's a bit of a, I guess it's not a. There's a lot of analysts who sit and cover stocks who basically key in whatever the management have told them. That's their forecast. Is they ask management, what are you going to earn next year, and then management will say 5%, and they'll then go, oh, okay, let me put a little bit different. I'll call it 6 or I'll call it 4. And so, because management haven't been issuing guidance, generally analysts haven't been changing their numbers at all for a lot of it. And so, so I'd just say anything you're looking at on the consensus basis, I'd be very, very careful to try and work out, how much basis is behind that. So we haven't seen the earnings yet. We think it'll be at least probably 15 to 20% down. You'll get much bigger write-downs, so this year will be even bigger. But I guess as a longer-term perspective, you need to keep in mind as well that companies have been running gearing at elevated levels, and companies are going to pull that back. So if they're running a gearing pretty close to as the maximum level, going forward they're going to have to pull that back, and that's going to mean lower earnings for shareholders. We're going to have a big deglobalization. Companies are going to be, so you're not going to have 100% of your supply chain in China. You're going to spread it out, and that's going to be more costly. You're going to need increased redundancy throughout people's systems. They're going to say, well, just in case something happens, I better have something in this country that can run, and something in another country that can run the same thing, and that's costly as well. And just the whole supply chain movements, that they're all going to be a negative drain on costs. On the flip side, you are probably going to see reduced rent and reduced travel. So depending upon that'll affect some companies more than others, and you'll certainly see new efficiencies when things change. Like people go through sudden shocks and they have to change their entire working process. You will find some companies will find that the new ways are better, and there will be efficiencies. But the net negative is on equities, and so we're still avoiding that until we sort of get a better view of earnings falls and recoveries. With bonds, your key thing there is there inflation coming from all the money that's being thrown at it from governments versus can I get safety from these? And so it's this trade-off about if governments put too much into it, then you're going to get inflation. We think the safety trade is still the play there. Although having said that, we're starting to lighten up, or certainly starting to look at lightening up on some of our positions as they keep falling. And then the Aussie dollar is the key one there. Is just sort of looking at what's going to happen. Is the Aussie dollar going to keep being a shock absorber for the economy? And the parts there, what's really going to drive that is, are we going to see this massive global stimulus where everyone's out building infrastructure, which is sort of a common theme you see out there? And if that's the case, then you get a lot of demand for commodities, which could then eventually drive the Australian dollar higher, or sooner if people think it's coming sooner. Versus, has there been disruption to all the supply chains and all the demand, and so you'll see the Aussie dollar lower because of commodity prices just aren't being used. And we're certainly leaning more on the disruption side, in that it's very hard to get out and spend lots of money on stimulus when people still need to be in lockdowns. And these the big projects that you talk about, they're not projects that you can turn on tomorrow. They're all projects that take a considerably longer time. Anyway, might leave it at that for the investment side, and maybe Martin, if you want to give us some.
Yeah, Martin. So look, thanks very much for your time today. And would you mind just sharing with our audience, of course, how they can get in touch and follow some of your work?
Yeah, sure. Of course, there's the Digital Finance Analytics blog at digitalfinanceanalytics.com. That's where we post all of our analysis. There's also the YouTube channel, which is actually called Walk the World, and that's full of videos that we make. You can also follow me on DFA Analyst at Twitter as well. So those are where we are found most of the time. And I'll be posting the more detailed analysis from the mortgage stress and from the financial confidence index over the next 2 or 3 days.
Lovely.
Looking forward to it.
Yeah, absolutely. Looking forward to that one. And we're looking forward to getting you back on the show sometime soon as well, Martin. Always a pleasure to have you on board and sharing your thoughts.
Glad to spend the time with you and the audience, and always happy to come back.
All the best. Okay, we'll talk soon.
Take care.
Thank you.
Bye.
So coming up next week, we have John Dinez, who's the CIO of Paragon Funds. He's had 14 years of financial experience in the financial markets, and he's been co-founding Paragon since 2012, and he sits obviously as the Chief Investment Officer. So we're looking forward to having a chat to him next Thursday, same bat time, same bat channel. Damien?
Yeah, so John's a long short manager, so a bit different to some of the guys we've had on here before, and so it'd be very interesting to see how he's trying to play it from both the long side and the short side, and he invests a lot in small caps as well as large caps. So just sort of seeing where he's trying to find safety in this market.
Yeah, it'd be fascinating to check out his thoughts given everything that's going on at the moment. So we look forward to catching you then. Cheers.